A bit of a scandal has broken out after the firing of an examiner by the New York Federal Reserve. Now, in the wake of the 2008 crisis, Columbia University professor David Beim was hired to investigate why it happened and why the regulators didn't stop it. Now, what he said was the biggest problem was a culture of finance. Now, Beim provided a path forward. What he did was he got expert examiners to come in, take a look at everything, and encourage them to speak up. He wanted them to say what it is they really thought and what would be the best thing to try to prevent, such a crisis from happening in the future. One of those examiners was Carmen Segarra, and she was fired after only 7 months. Now, the reason she was fired was because she kept resisting doing what they wanted her to do. She was hired to look for problems and then propose solutions. She kept pointing out problems that they didn't want her to point out, and she was gotten rid of before that. Now, the thing was, she recorded a ton of those conversations she was having, to the tune of about 46 hours of it. And this is all conversations she had with her colleagues and people she worked with. And they blocked her at every point, etc., on this whole culture thing, and she agrees that culture had a huge thing to do with it. Now, the article that I'm quoting from, Segarra's main complaint was the financial culture that prevents effective regulation. Now, the thing I would like to point out, having read this, is that it is not so much that, but that is the culture itself. There's no changing it. This is capitalism, and changing that would be counter to capitalism itself. Now, to explain why it's not just a culture that can be changed, but inherent to the system itself, I'd like to quote from my own book. The credit system is greatly inflated at this point, from the boom phase, and it's beginning to look a little unstable. Interest rates increase to begin to deal with the excess loans. Those who borrow money are finding their surplus value cut into by these new rates. This credit money they've created has gotten too far away from the token and metallic money they hold as reserve. To try to offset this, financial institutions begin making more short-term loans, hoping to get interest back quickly to build up their reserves. A large part of these short-term loans are consumer credit, mostly credit cards that are used for consumer purchases. This tends to help industry somewhat as it keeps up demand, if only artificially. If there was a shock to the prices of commodities or securities, it could bring down a bank or a firm. This is a point in time when financial institutions begin cooking their books to hide their situation from investors and the public. This is when they paint a rosy picture of things when really they're having a more difficult time getting people to pay off their debts to them. If they don't do this, they risk losing their customers and investors to other institutions due to competition. When all of the financial giants start doing this, we begin to see how nobody saw the crisis coming in 2008. The endgame begins when there are a few major debt holders that can't make their payments. During this time, those who sell commodities are keeping their sales up through the use of consumer credit, which demonstrates that the ability to consume is decreasing. To try and keep things afloat, consumer credit is extended further to fill any lag in demand. However, the ability of consumers to pay back these loans is also decreasing along with their ability to consume. This means the ability to keep up payments on consumer credit loans and mortgages is decreasing. The larger the debt, the worse things get. Now the financial capitalists are well aware of the impending disaster that is coming. They can see their balance sheets and they know how little people are paying back their debts. They know how far beyond their reserves their credit money is. In this situation, they begin taking huge risks to try and cover those debts. If a big, risky gamble can pay off, it can save them from their mounting, impending huge losses. This is when outrageous speculation begins to really take off. They speculate on everything: stocks, real estate, commodities, and whatever else they can find. All financial institutions are doing this because they're all facing a similar situation. This is how speculation gets out of hand. They do this because they have no choice. The only alternative is to have their financial institution collapse and go under, or at least lose tremendously to the competition. After the 2008 crisis, people all across America were attacking the banks for these crazy risks and speculations. It became a major point for talking heads on television and popularist rhetoric. Everyone was up in arms over the banks taking stupid risks that placed the country at risk and caused the gigantic recession. People demanded to know why regulators weren't doing anything. Why were those in charge of watching these people not stopping them from taking those risks? The mistake people make is that these huge gambles are an effect of, not necessarily a cause of, crisis. When faced with looming failure, what were regulators supposed to do? Stop them? This wouldn't have prevented the collapse from happening. It was going to happen anyway. These risks are the financial capitalists' attempt to deal with the problem that already existed. The only difference, had they stepped in, it would have been causing the crisis to come sooner. What is important here is to remember that these risky speculations and gambles are not some aberrant behavior that some crooked capitalist came up with. They're built into the very structure of financial capitalism itself. These contradictions of capitalism force them to happen. You can't have a real capitalism where this doesn't take place. This is the illusion of a good or fair capitalism. The system itself is a rotten, self-destructive thing that needs to be overthrown. The mistake people make here is that capital is not a tool that you simply pick up and then that depends on the moral character of the person who has it. Capital is a force itself. The reason it is a force itself is because capital exists not just as a thing, but also a mountain of social relations that lie behind its use. That's the difference. That's what these kind of examiners and regulators are not understanding. They can't seem to figure out why this corrupt behavior happens. That's because it's the very nature of capital itself. These things come from the very social relations that spring from the use of capital. This is capitalism. This is not some corrupt guy. This is the very system itself. Thank you for watching. Please comment and rate the video. If you liked it, hit subscribe or check out some of these other great videos. If you wish, share it on social media. While you're at it, why don't you follow me on Twitter? And if you got time, go on over to the MRN bookstore and check out some of the latest books available.